I think we can move on to the next session now, which is going to be on alternatives. This is going to be chaired by Mr. Manos Drossatakis. Manos is the CEO and CIO of Iolcus Investments. Manos has more than 25 years experience serving in a number of institutions. So Manos, thank you very much for being with us. And the floor is yours to introduce speaker by speaker and, take it from there. Thank you very much.
Thank you, George. Thank you for the introduction. As we all know, one of the major trends that we have seen in the past many years in institutional investor portfolios has been the shift in their asset allocation from traditional equity and bond investments to alternative assets such as private equity, private credit, infrastructure assets, real estate, and lately cryptos. We saw the graph from Mr. Panagiotou with the increase in their allocation in the last year. So today we have with us three distinguished speakers who will present the reviews regarding alternative investments. And without further delay, I will introduce Mr. Eduard van Gelderen. Eduard is the head of research of FCLT Global. He's assumed this role at the end of 2024 after spending over 6 years as Chief Investment Officer of Public Sector Pension Investment Board in Montreal, Canada. Prior to this role at PSP, he worked for the Investment Office of the University of California, and he was also the CEO of APG Asset Management in Netherlands. He started his career as an investment banker in Amsterdam and London. Over the years, Eduard served on several investment advisory boards. Currently, he's on the board of Enia Insurance, and he's a founder and co-chair of AIMA Global Investor Board. Over the past 2 decades, Eduard has published numerous articles and academic papers on fund management and strategy. He holds a master's degree in finance from Erasmus University, Rotterdam, and asset and liability management from the University of Maastricht. He's a chartered financial analyst and financial risk manager. He is currently a PhD candidate at the International School of Management in Paris. Eduard will discuss the Canadian pension model and the role of private assets in the strategic asset allocation going forward. So Eduard, the floor is yours.
Thank you so much for this introduction. Let me share the slides, or Maria, maybe you can share them. Is that possible? Is Maria there? Okay, let's find a way to get them. Well, thank you for the introduction. Maybe to emphasize one point, because in the introduction you've heard a lot of places, European and then North American, and where I'm now is actually in Canada, and that has a specific purpose. The thinking for me, my career really has been really from investment banking to commercial asset management to an asset owner. And the Canadian market has been always, a huge intrigue to me. It's the way they manage the money. When I was still at APG, I actually told my board at APG, like, gosh, please have a look at the Canadians, how they do stuff, because they seems to do something right. And that is a little bit what I'm going to tell in this presentation. If I'm correct, I've got only 15 minutes for this, so I will jump over some of the slides I have. But Maria, if you could go to the next slide, then I'll quickly tell you a little bit about the origin of the Canadian model. Why is that relevant for the private markets? I will tell you a little bit on how it's organized. Because I think that's also quite interesting. But then the key question is, like, what is the future really for private assets going forward? And, how does it then fit in basically a strategic asset mix? And has the view here in Canada really changed over all these years? And I can already tell you, yes, it has changed. But to give you some of the conclusions, I think there's still a very important role to play for private assets. Maria, could you move to the next slide? Thank you. So this is a beautiful slide, and I cannot take the credit for it. Someone else drew this, but it gives you a few messages, which I find quite important. First of all, some of the Canadian pension plans have been in existence for a very, very long time. That's on basically the left of this slide. What happened was actually in the middle of the slide that there was a restructuring of specifically the Ontario pension plan, and that is really in the 90s. So when you see in the middle of the slide that Ontario Teachers was launched in 1990, basically that was the result of the restructuring of the Canadian model. And after that, new pension plans, and I have to emphasize public pension plans. We're not talking about corporate or private pension plans. These are all public pension plans. So a lot of them were actually launched after that, but basically based on the very same model as the Ontario Teachers investment model. And what is important to realize is that in the 90s, one of the things that people started to realize was, well, if we need to fund basically the pension liabilities of the baby boomers, we need to have enough capital in the years 2020 to 2040. And there was a sense of urgency, like, well, the way we're organized now and the way the returns are going, this is not going to happen. We will not be able to cover those pension liabilities. And that triggered really the whole restructuring in the Canadian market. So it was really this sense of urgency, like, gosh, I need to fund. I need to do a better job in funding those future liabilities. And again, why I find it intriguing is because I spent quite some time in the Dutch market, and the Dutch also had that sense of urgency, like, gosh, are we really going to be able to fund the liabilities? But they took a very different approach by actually cutting the liabilities or making indexation conditional. That never happened in the Canadian market. In the Canadian market, the focus was fully on, can we do a better job in terms of our investments to stick or to keep the liabilities and be able to pay out the liabilities. So that's one of the reasons why I'm personally very intrigued. Like, they actually did a good job, and I will show you. Maria, could we move to the next slide? So the restructuring of the Canadian model, or basically not the model, but the restructuring of the pension plan was actually based on work that was done by Peter Drucker and a book that actually came out, The Unseen Revolution, How Pension Fund Socialism Came to America. So basically what he's saying in the book is like, gosh, the ownership of the wealth in the world is actually slowly moving to pension members. So individuals will actually have a large role to play going forward in managing the wealth of the world via those pension plans. And then the question was like, how do you properly organize those pension plans? And he had several principles. And that was like, well, the pension plans just need a single purpose. They need to be at arm's length. So basically saying like, the sponsors should not actually interfere in the running of these pension plans. They should be organized as high-performing organizations like any other organization or any other company. It's really not a non-for-profit. It is basically a business that you need to run, and you need to run it as a high-performance organization. And then two other parts is it's an integral part of the real economy. And that's true because, a lot of that pension money is actually spent on or is actually given to economic actors and companies. And then the last one is like, well, when you own, those companies, you actually need to get involved, work with those companies to see, where you can improve them, when you can make them better, etc. So those principles that he used in his book were translated in basically 5 principles that we still know as the 5 principles of the Canadian model. And the first one basically links to the single purpose. When the model was introduced, it was first and foremost for the members. So although there are different stakeholders in place, the thinking was like all the stakeholders should actually act with the sole purpose of delivering a pension to the members. That was really the guiding principle. And then the second one, the governance. When people speak about the Canadian model, they always raise this issue of governance. We have to be a little bit careful here because it is the governance related to investment decisions. So when you think about the way it's organized in Canada, there is a sponsor. The sponsor delegates basically to the boards, and the boards delegate to management. When we speak about governance in this setting, it is the sponsor has no involvement in investment decisions. That is really the role of the board, or even better, of management. But obviously, the sponsor can, say something about how the board is performing, how it's set up, etc. And I think one of the examples is what happened to AIMCO just a few weeks or a few months ago, where the sponsor, the government of Alberta, actually stepped in. And they've got every right to do so. So when we speak about governance, it's really like management is making investment decisions. That's what they're there for. Then the other part is in-house management, and that really relates to high-performance organizations. So what the Canadians have started to do is internalizing management of assets, not just on the public side, but also on the private side. So building up professional investment teams. And one of the things was, well, then you also have to pay them as professional investment teams. So one of the things that you will find is like the compensation that investors earn working for a public pension plan is relatively high. But that's really based on the principle like, well, you need to have the experts, you need to have the professional people to actually do the management properly. And then the last two parts is the integral part of the real economy that translate in investments in real assets and private assets. And I will touch on that a little bit later because that's pretty significant. And the last one is active ownership. There is still a large exposure to public markets too, but then it is kind of expected that we do engage a lot with these companies in order to make them better or to support them. Maria, can we move to the next slide? So what you find here is basically, and this is coming out of 2022, is the asset allocation of the Maple 8. And the Maple 8 is just a term that the Bank of Canada at a certain point introduced because they organized a meeting with these managers and they called them the Maple 8s. So there's nothing more to it than that. But these are the bigger, basically public pension plans in Canada. And there are a couple of things striking. If you really look at equity and bonds and basically take that as a proxy for the public market exposure, and you take all the rest as basically exposure to private assets and real assets, then you see that many of them have a very significant exposure to private assets and real assets. Not every one of them. Like AIMCO, for example, when you look at AIMCO, 70% is in public, but that has to do with the fact that the way they're organized and the governance works is slightly different there. So if I just give you an example, PSP basically got the mandate from the government of Canada saying, well, this is a risk budget, everything else is yours. So you're responsible for the asset mix, you're responsible for the choices you make in terms of regions, in terms of public, private, it's all yours. So enormous amount of freedom in terms of investment decisions. AIMCO, on the other hand, doesn't have that freedom. They work for different clients, and their clients have their own investment consultants. And obviously they do consult them, But at the end of the day, the decision where to invest, how to invest, what is the asset mix, is not an AIMCO decision. That is their client's decision. So you see that there are differences also in the asset allocation, but again, the conclusion is like, well, overall, there is a very significant allocation to private assets. Maria, can you move to the next one? And now the question is like, gosh, but where is this coming from? You know, why is this interest in the private assets so significant? And I think it's important to realize, if you go back, like what was the main purpose of the whole restructuring? That was really like, well, we need to have better returns. Otherwise, we will not be able to fund or pay out the liabilities of the baby boomers. So if you look at this chart, where it's the US and the Canadian government bond yields, that discussion basically took place to the left of the line. So the yields on the Canadian government bonds, you know, okay, it swings a little bit, but on average, it's like 7%, and that's amazing. So apparently, a return of 7% was not good enough to fund those liabilities. So they were looking for alternatives, for different ways to invest. And obviously, you know, you can move to the equity markets, but there was an additional problem. And the additional problem was like, there were restrictions in place at the time, how much those funds were allowed to invest abroad. And if you think about the Canadian stock market, then there are two observations. One is, it's actually a very small market cap. And secondly, there isn't that much diversification in that on the Canadian market. And that's still the case, to be honest. So they were triggered basically by this sense of urgency, the restrictions they had, and the need to really generate high returns to look for alternatives. And one of the conclusions was like, well, we can actually invest in private markets, and that's exactly what they did. And that is, you know, why the allocation to the privates are relatively high. Maria, could we move to the next slide? So did it really pay off? That's then the second question. Like, great idea, but you know, doesn't really get you anywhere. And these are the results of, again, the Maple 8 over, you know, taken in the year 2022, and then taking the 5-year average and the 10-year average. And what you see is like, by and large, and you know, for a pension fund, the 10 years is probably the most relevant. By and large, the 10-year performance has been pretty good. It certainly has been above, you know, what I showed you, the 10-year yields on the Canadian bonds. So there is a excess return that they generated. Then, of course, the question is like, yeah, but could you have done so just by having an allocation to equities? And that's why I put the 60-40 mix in there. Now, it is a bit quick and dirty, I have to admit, because, you know, I took the US. So it's 60% S&P 500, and it's 40% basically US 10-year Treasury yield. So it's not purely Canadian, and then of course there's a currency impact, and there are other factors playing a role. But it is a choice they could have made, like okay, let's stick to public markets and just allocate more to equities. But then over the 10-year period, that mix generated 6.5%, and the reality is that the funds over that period did significantly better. So clearly the private assets paid off. And I gotta say, there is for sure this idea that there is an early mover advantage in these numbers. The Canadians were one of the very first to really structurally invest in the private markets. Not many other investors did so. So there was an early advantage or early mover advantage in these numbers. But you would expect, like, okay, if you go closer to 2022, when other investors are moving that market into that market as well, then that early mover advantage will disappear. In general, it's true that the performance numbers are trending down. But funny enough, if you look at the margin or the differential between the 60-40 mix and the average number, that is actually widening. And of course, 2022, it was a huge success when you were in private assets. But this is, you cannot take 1 year as something that has any relevance, to be honest. 2022 specifically was a very weird year. And one of the things, for example, that I can emphasize is not every investor here on the left has a fiscal year that is equal to a calendar year. So CPPIB, PSP, for example, they have a fiscal year that ends at the end of March. So when you look at the numbers, here, even that 3 months period difference is on a 1 year horizon makes a lot of difference, because the ones with a calendar year, fiscal year that is equal to a calendar year, they mostly had very negative results. The ones that are actually extending had very good results. But, bottom line, what you can say is like, well, the private assets certainly played a role in the historical numbers of the Maple 8. And, so the whole idea of like, we need to do something, there's a sense of urgency, let's move into private assets. Yes, it did pay off. Maria, can we move to the next slide?
Sorry to interrupt, Eduard. Really impressive overperformance. We have another 2 minutes because we want to have some Q&A session at the end.
Okay,
So,
I'll skip
thank
this
you.
slide because that's more about how have they done it. So I have 2 slides and I'll spend 1 minute on each slide, if that's okay with you. So
Thanks.
what is the future of private assets? I think the market will change, and one of the main drivers is the whole digitization. So one of the things in the private markets was always this idea that there was no free information. It was hard to get information on deals. It was not, available to everyone. It was costly. So basically, it was a very opaque structure. I think the digitization is changing that drastically. So the information efficiency will for sure go up enormously. At the same time, what we've seen is that, Canadians were early movers, but a lot of other investors, other pension plans, sovereign wealth funds, you name it, they all started to move into private markets as well. So the demand side of the market is growing enormously. And I think with all these different participants, in addition to information efficiency, more participants in the market will lead to better market efficiency as well. So going forward, I firmly believe that the premiums that were there will definitely be lower on the private assets going forward. And another thing is there's more and more research ongoing saying like how different are the private assets really from the public assets. And the whole factor investing and the research into factors shows that basically, they're very much overlapping. A lot of the performance that is driving private assets are actually very similar to the factors driving the public assets. So that is a very important takeaway. And if we move to the last or the next slide, another thing that I find is influencing or impacting the investments in privates is this whole concept of total portfolio, the total portfolio approach, which basically means let's forget about the asset silos and let's just think about all possible investments and let them all compete. So we're really going for the best performing assets that we have available. Again, with the whole research and the whole development in terms of factor investing, I think that makes a lot of sense. So what I see happening just because of this approach, there will be a more conscious decision whether to invest in a public or a private on the basis of the factors, and not so much because they are illiquid in terms of private and they're actually liquid in terms of public. And then the last point is artificial intelligence. It will impact our world. And I'm convinced that definitely also portfolio optimization will be impacted by AI techniques. It will lead to better insights in the return drivers. So a even deeper understanding than the factors that we already have. It will be, come to different ways of coming to correlation, because AI will have techniques where we cluster investments, whether they're public or private, it doesn't matter anymore. And then, I think that there are going to be better insights in the higher moments. So basically, what does the return distribution look like, especially in the tails? And again, I think that is where, the publics and the privates, it doesn't matter that they are in two different segments. It is really about what are the features of these investments going forward that is important. So concluding, Maria, last slide, please. And basically just jumping to the last one is, I really believe that, let's say the last two bullets, the private assets are not disappearing. They're very important. They really broaden our investable universe, and that is very important. Secondly, is yes, it's very important, but I do believe that the public and the privates will become, will almost get closer to each other, and not the way it was seen when the Canadian model was introduced, like, oh, there is a different market that gives a premium. I think that is gone. I think that is something to the past, but it doesn't mean that the private assets do not have any value. So on that note, I conclude my presentation here.
Thanks a lot, Eduard. Thanks for the presentation. We can now move on to the next speaker, who is Elena Vakali. Elena is a Senior Managing Director and Head of Portfolio Management Europe at Hines, and is responsible for investment execution and operation of real estate funds and separate account mandates in Europe, currently managing 14 billion of assets across property sectors and various risk-return profiles. Prior to this position, she was part of the Hines European Fund. Elena joined Hines in 2013. Before that, she held fund and asset management roles at AXA Real Estate and JP Morgan Asset Management in London. Elena started her career as a junior auditor at Ernst & Young in Athens. Elena is a member of the Royal Institute of Chartered Surveyors and holds a bachelor's degree in finance and banking from the School of Finance and Statistics, University of Piraeus, and a master's degree in real estate investment and finance from Henley Business School in the University of Reading, UK. Elena will discuss the risk and opportunities in investing in real estate. So, Elena, the floor is yours.
Thank you. Let me try and share my screen. Is it working? Can you see my screen?
Yes, we can see.
That's great. So thank you for the invitation. I'm very happy to talk about real estate. Private real estate is an asset class that is often underrepresented in investor portfolios, which itself presents an opportunity. As the previous speaker said, of course, there has been a change in private and public markets and how investor portfolios are allocated, but we do believe that real estate is a very attractive investor opportunity. It has inflation hedge characteristics, as you can see in this chart. Historical data show a positive correlation between property rent growth and inflation. And as such, we believe real estate investments have the potential to preserve purchasing power and generate attractive returns, maintaining or in some cases outpacing the inflation rate. And today is a great time to invest in real estate, in my view. Globally, 60% of the world is what we would call fairly priced. This is based on our in-house pricing model at my firm, where we are looking at real estate pricing today in absolute terms and also in relative terms. And property yields are attractive in the same way when we look at them in absolute terms and also in relative terms against other asset classes today. And when we compare real estate spreads today with their long-term average, these are indeed attractive in today's market environment. This slide I would like to take a little bit more time to explain. It's a little bit complicated, I appreciate. Let me say that in order to assess real estate market dynamics, we track two cycles. The first cycle is, of course, investment markets, the availability of capital, the pricing, and we look at that both for real estate and within real estate, differentiating amongst the different real estate sectors. And then the second cycle we track is the real estate fundamentals. Here we are focusing on occupier supply and demand, which together drive the vacancy and rental growth of the market. And at my firm, we have developed a proprietary research model looking at these dynamics. And we focus very much on pricing and leasing momentum. And the best time to buy is clearly when pricing is cheap and fundamentals are strong. That's what we call here a strong buy phase. This phase is usually short-lived, though. This is because more capital starts chasing deals and pricing increases quickly. Earlier phases in the cycle, which we call early buy or just buy phases, have weaker or recovering fundamentals, but are still great vintages due to the dislocated capital markets, which result in attractive pricing. And we have historically seen very, very strong performance of those vintages. Looking at this opportunity in Europe, we estimate today that extensive repricing over the last 2.5 years has positioned 2/3 of the market in one of the buy phases. So we believe this points to a renewed era of real estate investing, and we think that presents a generational opportunity. Next, I wanted to go a little bit deeper to look at the sectors that we have conviction that they present opportunities, and starting with living. Almost in every country in Europe and in many countries globally, there is an imbalance between demand and supply for residential property. And we are deploying capital with a focus on build-to-rent investments and also purpose-built student accommodation, specifically in terms of the subsectors within the living sector that we focus on. So starting with build-to-rent, or BTR, as the acronym is, we see that households increasingly favor renting over buying in several developed markets. This trend aligns with the global affordability crisis, which is driven by the widespread housing shortages and also rising mortgage rates. And our focus is on many of these markets where the ownership of rental properties is extremely fragmented, and there is very, very little institutionally built, owned, and managed residential product. And then, on the other hand, I mentioned earlier the student accommodation, which is purpose-built. We see expanding secondary school population, so looking at the demographics in Europe, and also increasing international demand for European universities. These together point to continuous market tailwinds for student housing investment. But also, in real estate, it's obviously extremely important to choose the right locations. So which university cities are the most popular, essentially which universities are most popular, which are high quality, and also the micro location of the asset relative to the university. Is it walking distance? Is there good transportation? All of those factors are key in order to choose where to acquire or develop student housing properties. Next slide. Here we have referenced the retail sector. Sorry, I'm struggling with a cough. So the retail sector has been repriced both from an occupier and a capital markets perspective. Rents have declined across Europe and yields have increased significantly over the last few years, partly as a result of the headwinds of the e-commerce growth, and of course also due to the macroeconomic market conditions. But the sector has, to a large extent, been right-sized. We see retailer demand recovering, and consumer confidence is improving. The assets that have survived today and are performing well do so because they are strong fundamentally, and now they have the benefit of facing less competition. Pricing for retail real estate has been very attractive because essentially the capital markets have disregarded this sector for so many years and penalized that sector. And we are focusing mostly on those markets where we see the fundamental growth opportunity being strong. And this is where we see cities with both actually strong local spending and high tourism. On the next slide, I wanted to touch a little bit on industrial and logistics. This sector has had a very good run over the last few years, partly driven by the market dynamics during and following the pandemic, in a way the opposite effect that we saw in retail. Fundamentals are moderating in this sector. There is more availability, but investment markets are still very favorable to industrial and logistics, which in a way might be disproportionate and has resulted in the sector looking expensive in certain cases. And on average, we consider it at least fairly priced. Having said that, construction is now pausing and last mile logistic locations are still tight on supply. So there are opportunities in some of the European markets where the NOI growth will continue, even if that is at a lower pace. And in industrial, there is further upside for some of those development sites available where the location and crucially the energy supply make them attractive opportunities for data center development, which is a very hot sector, subsector in real estate today. And lastly, offices, another sector that has been impacted by the pandemic. Focusing for a moment on grade A offices, we see a different impact on those. Capital markets have penalized offices quite significantly. We've seen yield increases across Europe after the pandemic and the subsequent hybrid ways of working. But actually, at the prime end of the spectrum for the right assets in terms of quality, amenities, and the right locations, of course, demand from occupiers far outstrips supply. And for many cities, such as London, which is where I am based, the new supply hitting the market over the next 10 years is predicted much lower than the demand for this type of space. The estimated return to the office for Europe is somewhere around the 60 to 80% mark. With that in mind, the most desirable offices, I think, will create competition. And this is what will be driving rental growth at the prime end of the market in the future, as is the case already today. And we expect this to continue. Lastly, I wanted to touch on some risks. And ESG is a great one to start with because this is a risk and an opportunity at the same time. I just referenced demand from occupiers when we were talking about offices. One of the criteria that many corporates are focused on is increasingly ESG. Some tenants, some corporates have specific carbon targets, and those have limited lease options that are able to match those goals. Buildings with strong ESG credentials and the other characteristics that I was referring to are seeing strong demand. And in those cases, again, I expect that we will see rental growth come through. Also, the other side of the ESG measures is the cost savings that this brings for landlords and tenants. And in both cases, even if the savings are for the tenant, this will benefit the landlords because occupiers look at their total occupational cost, not just rent. But there are, of course, many risks. Environmentally, climate change is crystallizing as a real and present danger. And we see that those that don't keep pace with the changes will be left behind, may face carbon taxes or pricing implications for their investments. And we are seeing, or we have been seeing in the market, a greater divide between those who lead on ESG and those who don't. Having said all that, the political environment is obviously changing. The new president has just signed an executive order removing the US from the Paris Climate Agreement. Several US and European asset managers are pulling back on the public show of climate actions. So it is a very, very evolving market environment from that perspective. And geopolitics more generally will undoubtedly be a huge risk factor, which is completely outside of our control. And we will continue to see more uncertainty as we have been seeing across a number of regions globally. And of course, the economic environment. Whilst I am generally bullish on investment conditions, it is true to say that some economic weakness remains in the traditional core of Europe, like Germany and Sweden, while some of the South European markets, Spain, Italy, Greece, or Ireland, on the other side, appear more resilient due to market reforms and also many years of deleveraging. So caution is still needed when you look at real estate investments at a country and also at an asset level. And of course, interest rates, it's a different world of interest rates we are now in. That means that cheap financing and capital rate compression that was really one of the big drivers of value growth in the previous cycle is not going to be the case anymore. So focus on property level is going to be key in order to generate rental growth as a key driver of the value growth for real estate portfolios. This will be an opportunity on the one hand for those managers who are able to outperform through superior market and investment selection and also proactive asset management locally, but those investors that don't have those abilities might struggle in the new economic normal. This concludes my slides and comments.
Okay, thanks a lot, Elena. Thank you for your interesting presentation. Now we move to our next speaker, who is Professor Carol Alexander. Carol is an expert in financial markets, especially risk analysis, derivatives markets, hedging, volatility analysis, and crypto assets. Carol has a PhD in algebraic number theory from the University of Sussex, a master's degree in mathematical economics and econometrics from the London School of Economics, and a bachelor's degree in mathematics and experimental psychology from the University of Sussex. She has published over 80 research papers in academic journals in various subjects. Carol has a dual career in industry and academia and is currently Professor of Finance at the University of Sussex and visiting professor at Peking University Business School. He is the author of the 4-volume textbook, Market Risk Analysis. Her latest book is an unedited volume on corruption and fraud in financial markets. Carol has served as chair in the Academic Advisory Council and has held corporate roles as a director and head of market risk modeling for Nikko Securities, as academic director of Algorithmics Inc. and risk research advisor for SAS Software. Carol currently sits on several academic and practitioner advisory boards and appears regularly in the media, most recently about crypto asset markets, which will be the subject of her presentation. So, Carol, the floor is yours.
Thank you very much. Shall we just take a check on time? I think this session is due to finish in 5 minutes.
We have 15 minutes for the presentation. If it is shorter than 15 minutes, we might have some 2 or 3 minutes for some questions.
Okay, all right.
Okay,
well, I'll try to be shorter than 15 minutes then.
Thank you.
Okay, let me share my screen. Okay, so the title of my talk is The Future of Crypto. I'm no longer visiting professor. Well, I'm still on the pages of Peking, but I haven't done any work for them for a while. But I am working with the Exponential Science Foundation as a research council. And if you want to find out more about myself, this is my website. Okay, so I've only got a few slides. The first thing I need to explain, because it's so new, is what exactly is crypto. So this page was taken from CoinMarketCap a few days ago. You can see the trending coins. Buzz is a meme coin. I can tell that by the fact that it's gone up 42% and its price is about 8 cents. Meme coins were really one of the biggest phases last year and in 2024. Previously, we've had things called non-fungible tokens, NFTs. We've had a craze for initial coin offerings, which now go by the term token offerings. Terminology changes all the time, and it's almost a full-time job just keeping up with it. So, I mean, when I looked at it a few days ago, the total market cap was 3 trillion and 3.33 trillion, a more or less all-time high, driven by the rise of Bitcoin to over $100,000 per coin. Ether is the second. It's not everything really should be called a token, and Bitcoin and Ether are native tokens. In other words, they're utilities that are required for running smart contracts on blockchains, although Bitcoin isn't. Bitcoin blockchain doesn't take smart contracts, it's just a toy. Bitcoin doesn't have the same utility value as Ether. Ethereum blockchain underlies the whole of decentralized finance. Dogecoin, as the US call it, Dogecoin, is actually a native token. People call it a meme coin because it's been adopted by Elon Musk just to show that he can make himself lots of money by making a tweet to the moon. And of course, he's now head of the sole head of the Doge department. So this coin has been trending. And then we have the Trump meme, which went up a lot at this point, but there are more than one Trump meme. I made a LinkedIn post about what's happening with Trump coins. What else do we see? We see the decentralized exchanges here. These are trending. These are all meme coin type things. As I said, meme coins are traded off-chain, although there is something called pump.fun, which is banned in the UK, where you can, take a bet on whether there's going to be a social media hype of a phrase. That's all it is. It's just, it's basically a lottery. Will lots of people buy it? In which case I might make money. You can buy lots of them at this sort of price. Okay, so let's have a quick look at what's happening at the moment there we are. So this is another meme coin. So is Monkey. Lots of meme coins trending at the moment. And looking at the categories, we've got these NFTs, CryptoPunks, Bored Apes, Azuki, things like that. They're still going, but the NFTs were really the flavor of the year in 2021. You have categories of rehypothecated crypto. There's a huge amount of double counting of the cap of crypto because you can wrap up Ether into wrapped Ether or Bitcoin into wrapped Bitcoin. You can also get rehypothecated coins like staking, which is what's driving the developments in decentralized finance. As I said, there's a big overcounting, 163 billion of double counting of the value of the crypto market just because of rehypothecation. Okay, so that's a brief introduction to what is Bitcoin. But if we just look at standard things like Bitcoin, Ether, Solana, Polygon, and Ripple, and all the other things that have been around for many years, the volume of trading per month is about, 1 to 3 trillion. The dominant exchange, and these are off blockchain. It's like, it's a motorway service station. Think of a blockchain like a motorway. Think of smart contracts as like lorries. that carry instructions or actually carry washing machines from Germany to the UK, you know. This is a prime example of the use of blockchains and decentralized finance, which is driving the new digital economy. So it's all going there under the radar, just like generative AI developed under the radar and then just sort of exploded on the scene this year, taking us all, at least in academia, rather by surprise. But anyway, these centralized exchanges, they run limit order book type things, but there's no regulation on any of these. The largest is Binance. They do multiple processes. They also run futures. They do their own clearing. They have their own blockchain. They're their own broker. There is absolutely no regulation or separation, independent oversight whatsoever. And so the sort of strategies, the trading strategies, you can even get 5-10 times leverage on spot, right? And you can get 100 times leverage on futures, 1% margin. And you know, people get liquidated all the time by the exchanges. They get made bankrupt. It's really very, very dangerous. And there's an awful lot of trading going on, as you can see. And then we've got the decentralized exchanges. These are on-chain. And Uniswap is one of the biggest ones, Radium and so forth, much, much lower volumes. And these don't run limit order books. They run a completely new method of trading called an automated market maker, which has a sort of hyperbola curve where the price and quantity are inversely related. And you have liquidity providers who have to put both sides of the swap in the right current prices. And then you get people that put in one and take the other. These are the swappers and these are the liquidity providers. It's just not seen in traditional finance. So many things are just not seen in traditional finance. But nevertheless, the boundaries are blurring, as I will explain. We have futures contracts that don't exist in traditional markets, inverse futures, which allow you to margin and settle in crypto, even though you're actually trading against fiat, and perpetual futures that never expire and so need a different type of pegging mechanism to the underlying, which is called a funding rate. And there have been some precedents for these perpetual futures in traditional markets, but they've never taken off. But nevertheless, they are the main futures that are traded, that do the price leadership. And most of it is on Binance, but Bybit as well. A lot of retail trading on Bybit, a lot of professional investors in Binance. They're not allowed to in the US, but they use VPNs. We know that because of the time of day that people are trading. Volumes of futures are similar to spot, and Binance is, again, the main exchange. And Ether, Ethereum is the blockchain, Ether is the coin. It's a bit confusing for Bitcoin because Bitcoin is the blockchain and Bitcoin is the coin. But Ether is the coin for the Ethereum blockchain. Nevertheless, not everybody knows that. So that's why these are called Ethereum futures instead of Ether. About half the volume of Bitcoin, and the price of Ether is around 3,000 or 4,000 as opposed to 100,000. Okay, so the future of crypto. Well, Trump's going to change an awful lot, not just showing that he's completely above the law, that he can make himself 10 billion over the weekend by launching his own meme coin, of which he owns 80%. And then Melania got in on the act. And then so did Ivanka and so did Barron, although their coins didn't take off. I mean, this is just so in your face. I can do whatever I like. But notwithstanding what's going to happen with the Bitcoin reserve, which is ridiculous. I mean, I don't think that's going to work, but that's another, that's a more US-centric comment. I'm just talking about general crypto in this talk. One of the things we're going to see is more merging of traditional finance and decentralized finance. Already we have Bitcoin ETFs. So, you know, if you use Hargreaves Lansdowne or something like I do, you know, you can buy US stocks and you can also buy Bitcoin as a share and Ether as well. And there are more and more ETFs. In particular, on the right, this is the Black Dragon, which it's an analyst for token offerings. There are thousands and thousands and thousands of crypto. People are crowdfunding their new companies. Some of them are scams, but most of them have got proper white papers and they have a roadmap. And so you can use Black Dragon to get some good early investments when you have, even before the token offering, i.e. it's launched on Binance or on a decentralized exchange like Uniswap. And these things will be bundled up into ETFs so that more and more ordinary investors can take part in specialized crypto ETFs. And on the left, we see Stocks, which is a company that is onboarding fractions of the Tesla share or Apple shares and so forth, so that they are now traded 24/7, 365 days a year, just as crypto is. And the type of exchanges that you're going to be trading them on have no rules. So manipulation with 100 times leverage is going to make traditional assets an awful lot more volatile once this takes off. Then Tether, stablecoin. I couldn't just not mention that, particularly since Tether is now relocating to El Salvador, which is becoming the one of the richest companies in South America because of its Bitcoin reserves. Tether has completely changed from being something that was avoiding any audit of reserves to a company that now has 6 billion, as we can see here, 6 billion net equity. Its assets are properly audited and its liabilities are 6 billion less. Tether's already invested heavily in volcano energy in El Salvador, and now it's moving to its quarters to El Salvador. We can see how the increase in Tether circulation in the dollar form, not in euro, this is stagnant, Mexico and China and don't quite know which Tether this is. These have been stagnant. In fact, the MiCA, Market in Crypto Assets law in the European Union, forbids too much trading in stablecoins. But Tether is now dollarizing America and Africa, and this is set to continue. And the biggest thing that I've finished now, it's my last slide, is the unchecked growth of decentralized finance, completely unregulated. What people see is the top of the iceberg. Underneath the iceberg, there are not just these decentralized exchanges, but there is a whole new type of economy, and financial markets are growing out of control. There's rehypothecation hundreds of times because of staking and lending platforms. There's looping and looping of sort of creation of value. I don't have time to go into it, but maybe on another talk.
Okay, thanks a lot, Carol. Really interesting presentation. We have time for a quick question, just 1 minute. So, are there any economic fundamentals that are driving crypto markets?
Yes.
And
yes.
What are the drivers, apart, of course, from the supply demand?
So the digital economy, moving a washing machine from Germany to the UK, for example, that supply chain is an early use case of blockchains, and the Ethereum blockchain is like a multi-lane motorway. It's sharded now, and it can carry a lot of smart contracts. And we're moving towards more and more of a digital economy, so we do need digital assets. Some countries are moving towards CBDCs, central bank digital, but that adoption is slow, which is why we've got all these stable coins. So think of Ether as a utility token. It's required. You pay for a smart contract to get your washing machine from Germany to the UK. All the different port authorities, the banks, the exporter, the importer, and there's insurance companies, there's all these different intermediaries logged into one blockchain. Everything happens atomically, automatically, if this then that code. And for every movement, you have gas, and gas is measured in Ether. So Ether is necessary for running the digital economy.
Okay, thank you. So many thanks to all our speakers for their really insightful presentations. George, over to you.
Thank you very much, Manos, and thank you very much, Elena, Carol, and Eduard. Very insightful. In the concluding panel, we're going to hear more, I guess, on the views already expressed.